To make a move like that, you have to have kahunas and conviction.
Long term, I'm bullish. We could see about a 20% correction next year.
This is Josh Jelinski, the financial quarterback. Don't touch that dial. Hi, everybody. This is Josh Jelinski, the financial quarterback. And on my past podcast, we talked about the 27 drawers within the financial modeling system that we use. But first step is you got to know what you have. So I'm going to give you the rules of the model and the rules of the game of wealth. I'm the financial quarterback. So football has rules. Wealth has rules. What are the new rules of wealth that we're going to teach you? There is a structure to what you have. Similar to building a house, you have an architectural rendering. We will give you an architectural rendering of your financial life. You have to organize what you have, then you have to coordinate it, then you have to monitor it. But just as important, if not more, is knowing how to strategically use the model to enhance the efficient and effective use of your money. Well, how do we do that? Through the 9 rules. Rule number 1, full replacement protection. Unforeseen events can happen at any time. And the rule is this: how much would you want if you lost your life? How much would you want if you lost your job? How much would you want if your house burned down? Full replacement value of the asset is critical. So what does that mean? If you have car insurance, you want full replacement of your car. If you have a $100,000 car, if you have a home, you want what's called, there's actually in home insurance, you want to say, I want to get full replacement value of your asset. So there's a formula for you to know what's the optimal car insurance, for you to know what the optimal home insurance, for you to know what the optimal liability, and generally it's how much insurance would you want after the claim? So if you knew a day from now that your house is going to burn down, how much insurance would you get? Well, you would get the max, right? Within reason, within reasonable costs in the event of a claim. And a properly designed protection component, that's your moat around your castle, is a higher priority before any savings and investments are fully developed. Meaning, if you're living paycheck to paycheck, right now you're listening, you need car insurance if you drive, you need home insurance if you have a home, you need disability insurance if you have an income, because if you get disabled and you have a mortgage, you're going to lose your house because you got disabled. So you need disability insurance before you buy a home. You need life insurance if you have kids or a spouse that's relying on your income as income replacement. And that is step 1, full replacement value. That's rule number 1. Rule number 2, save at least 15% of your income. They've done studies of people in other countries like China where they have a savings culture. We need a savings culture where you save 15% of your income, regardless of what happens, because saving 15% is the solution to the wealth eroding factors. Wealth eroding factors are like ever-present inflation, taxes, market fluctuations, law changes, lawsuits, technological changes, unexpected life events, fees and consumer financing, increased standard of living, and planned obsolescence, wear and tear. I'm going to do a whole show on what the wealth eroding factors are. But the only way you can combat the wealth eroders is to have a very high savings rate. It's not even income, it's savings rate. Rule number 3. So number 1, full protection. Number 2 rule, 15% saved. Number 3 rule, build liquidity of at least 6 months of your income in checking accounts, savings accounts, credit unions, wealth coordination account, savings bonds, CDs, or money markets. If you don't have an emergency fund, like, why invest? Because your life would suck if you lose your job. There's a reason you have an emergency fund. It's so that if you lose your job, it might take about 6 to 12 months to get back on your feet. If you have 6 months of your income plus unemployment, you should be okay. But rule 3 is critical. You have to build liquidity. Ready money is Aladdin's lamp. You need opportunity funds. This enables you to operate on a cash basis and minimize loans and loan interest payments and principal payments. A lot of times people can't get ahead because they have heavy interest payments. Liquidity is a powerful tool that many people overlook. Cash is not crap. Cash is not trash. Liquidity can be a powerful tool when presented with unforeseen events, opportunities, rising interest rates. People can't buy that big house now, but if you had a lot of cash, you now have opportunity. Rule number 4, avoid compounding taxable interest. Now, compounding creates wealth. I'll do a whole show on that. The miracle of compound interest. But there is a nightmare of compound tax that can substantially erode your wealth. By withdrawing interest as it is earned, rather than allowing it to compound, it converts a compound tax to a flat tax, reducing out-of-pocket tax payments. Earned interest should be automatically transferred to a special account that we call the wealth coordination account that collects and tracks and repositions all your money. So step 4, you build that wealth coordination account. This is an ordinary checking account with an extraordinary purpose. A lot of people don't do this. It is for segregating money for careful and strategic use in your model from your ordinary everyday expenses. It's like an automatic account, auto-save account, as I call it. Failure to protect this important money often results in simply it gets spent, it gets absorbed. It's based on the economic principle called the propensity to consume. The more you make, the more you spend. So the wealth coordination account is like a hack for your brain. I call it the autosave account. My mentor called it the wealth coordination account. Failure to protect this money is important because too often you spend it, you blow it, then you have increased cost and unfortunate other costs called LOCs or lost opportunity costs, which is a big point. Do you have a model that incorporates cost accounting into your plan? We do. We account for lost opportunity costs. It's a factor. Once you've satisfied the rules of saving 15% of your pay, getting 6 months saved in an emergency fund, and then making sure you have that wealth coordination account, then and only then should you max out your 401k. Should you contribute to the 401k? But you don't contribute the max first. You contribute up to the employer match portion first. Now, eventually you max out, but first you want to at least get the employer match. Many 401ks offer an employer match. Something like they give you 3% of your salary or 50% of up to the first 6% of your salary. And you want to contribute no more than half of your gross annual savings rate to the retirement account. Why? This is because your plan should be balanced so that you have adequate protection, adequate liquidity, because you don't have a lot of liquidity in your 401k. I'm talking about strategic diversification. Okay, I have some Roth, I have some insurance, I have some 401k, I have some emergency fund. You have these different buckets of money for different things and you're coordinating them. Rule number 6 is be a lender. Once you've completed your full protection and you have savings component rules and requirements, you are then ready to go into the growth component. These financial assets, and rule 6 is be a lender. Loan money to the government, get a treasury. Loan money to a municipal government, get a muni. Loan money to a corporation, get some interest. These financial assets are more income-oriented, more conservative generally. Some even have guarantees, and some have lower risk. Rule number 7, be an owner. You're never going to be amounting to significant wealth if you're just a lender. We want you to own trophy financial assets, companies, car washes, businesses. You get to participate in the potential profitability of the company and appreciation of their value. Then rule 8, own hard assets. So a lot of advisors too, the reason I love my model, you'll have bond people, you'll have stock people, and they usually don't mix well, and then you'll have hard asset people. I believe in all of them. Why? Let's say you love real estate and you're a hard asset person. Well, you would need liquid assets to buy more real estate, which can be in the growth component, in lending-based assets or equity-based instruments, or in emergency fund type vehicles. Those growth assets have the greatest opportunity for building wealth, but have the greatest asset. Think owning a business, owning like your own business, a tax shelter, real estate. These financial assets provide opportunities for income and growth while providing tax benefits. Similar to the second tier, you are an owner of these assets and businesses, and you may control these assets, enjoy their use and gain tax benefits, receive income now off the rents, build capital appreciation, and significantly reap many other advantages. Rule number 9, once you've built this, now you got to maintain, balance, and monitor your plan. That's the hardest for a lot of successful people. They just get too busy with this. You'll need to periodically rebalance your model to adjust for the changing circumstances in your life and the economic world around you. This is taken from the LEAP model rulebook. The ongoing use of the model is designed to help you organize your financial life, make each dollar work efficiently, give you peace of mind, increase protection against unknown risk, provide greater income, greater legacy, greater control, and simplify your financial life and decision making. Now, what about debt? How does debt play a role into your very financial picture? Debt management plays an integral role in your life. Too much consumer debt or high interest credit card debt, that's bad debt. We don't want any of that. Will negatively impact your cash flow and limit your wealth building opportunities. Good debt can be characterized by low interest. It's potentially deductible. It's an installment payment plan. Bad debt, high interest, non-deductible. Too much revolving credit. Again, I'm going to give you a rule book summary. Rule number 1, full replacement protection, max protection. Rule number 2, save 15% of your earned income. Rule number 3, build a liquidity fund of minimum 6 months in the bank. Rule number 4, avoid compounding taxable interest. Rule number 5, contribute to your retirement account. Rule number 6, be a lender. Rule number 7, be an owner. Rule number 8, own hard assets. And rule number 9, maybe you have all those 8 things. Are you monitoring what you're doing? Are you balancing it strategically? Not a rebalance. Notice I didn't say rebalance. I said balancing what you have strategically. And what is the end game of all this? It's literally to get 12 checks in retirement. And the categories are really 8 different streams of income in retirement. Did you know that you can get 8 streams of income in retirement? And for our clients, it could be a normal occurrence. How so? Well, following the rules of a successful plan can help you create an enjoyable retirement by continuing protection strategies throughout retirement. Enjoy many kinds of retirement income, not just 1 or 2. And I'll reveal those at the end of the show. 3, reduce fear of running out of money. A lot of people, their biggest worry is running out of money. There are products that solve that. There are strategies that solve that. Number 4, generate income through a pay down strategy. What's a pay down strategy? You don't have to leave $1 million to your kids. Maybe you pay down that account so you have a little more enjoyment, a little bit more fun. So instead of being rigidly applying the 3% rule to spend it over a 20-year period, you do a pay down. You do a reverse mortgage so that you have the equity in the house, but you're enjoying the equity. It's not just trapped inside your house. Also, you want to increase access, use, and control over assets and income. And then we want to create income that is more tax efficient and diminishing the impact of law changes, particularly tax law changes and market fluctuation. A lot of people, if they change the tax law, you'd be screwed. So you got to be careful. You understand how the rules work and how to get them back in your favor. And then ultimately to provide a legacy for you and your family, the people you love and the causes you love. So let's go over how you can position. I want you to write this down. 8 streams of income, 8 multiple streams of income that you could get. So those are the 9 checks that we can help a listener make. Again, 9 checks are government programs, trust income, life insurance loans, withdrawals, and dividends, checking, savings, cash accounts, interest, principal, and paydowns, annuities, pensions, retirement income, interest, dividends, and principal paydowns on stocks and bonds, and capital gains, and income from real estate. I want to thank you all for joining us. Make it a great day.